Preparing for a quantitative analyst at JPMorgan Chase Co interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you explain the role of a quantitative analyst at JPMorgan Chase? I would describe the quant role as using math, statistics, coding, and market intuition to solve financial problems. At JPMorgan, that could mean building pricing models, measuring market or credit risk, improving trading analytics, or validating model assumptions. The key is not just deriving formulas, but producing robust tools that traders, risk managers, and regulators can trust. I would emphasize accuracy, scalability, documentation, and clear communication with non-technical stakeholders. While answering, focus on model development, risk measurement, pricing, data analysis, and collaboration with trading, risk, technology, and model validation teams across a large regulated bank. Question 2. Walk me through how you would price a European call option under Black-Scholes. Black-Scholes prices an option by valuing its expected payoff under the risk-neutral measure. I assume the stock follows geometric Brownian motion with constant volatility, no arbitrage, continuous trading, and a constant risk-free rate. For a European call, the formula depends on spot, strike, time to maturity, volatility, rate, and dividends if included. In practice, I would also mention its limitations. Volatility is not constant, markets have jumps, and liquidity affects hedging. Make sure to cover the assumptions, risk-neutral valuation, log normal stock dynamics, discounting expected payoff, key inputs, and limitations when applying Black-Scholes in real markets. Question 3. What are the Greeks, and how would a trading desk use them? Greeks measure how an option's value changes when market inputs move. Delta captures spot sensitivity. Gamma captures delta's curvature. Vega measures volatility exposure. Theta reflects time decay, and Rho captures rate sensitivity. A trading desk uses them to hedge positions, understand profit and loss drivers, and manage limits. For example, a delta-neutral book may still have large gamma or vega risk, so Greeks help reveal exposures that price alone does not show. In your answer, talk about delta, gamma, vega, theta, rho, first-order versus second-order sensitivities, hedging use cases, and how Greeks support risk aggregation. Question 4. How would you estimate value at risk for a trading portfolio? I would first define VAR as the loss threshold not expected to be exceeded over a given horizon and confidence level. Then I would choose a method. Historical simulation uses past returns. Parametric VAR assumes a distribution, and Monte Carlo simulates risk factor paths. I would map portfolio positions to risk factors, revalue or approximate profit and loss, and validate through backtesting. At a bank, I would also compare VAR with stress tests, because VAR can miss tail events. Be sure to mention historical simulation, parametric VAR, Monte Carlo VAR, confidence level, horizon, portfolio mapping, backtesting, limitations, and why stressed VAR matters. Question 5. Explain the difference between real-world probability and risk-neutral probability. Real-world probability describes how we believe assets will actually evolve, including risk premia and investor preferences. Risk-neutral probability is a pricing tool where expected discounted asset prices become martingales. Under this measure, I do not need to estimate the asset's true expected return. I use the risk-free rate to discount expected payoffs. That is why derivatives pricing often uses risk-neutral dynamics, while forecasting, portfolio construction, and economic capital often require real-world probabilities. While answering, focus on measure choice, expected returns versus discounted pricing, martingale logic, derivatives valuation, and why risk-neutral probabilities are not forecasts of actual outcomes. Question 6. If two normally distributed risk factors are correlated, how would you simulate them? I would start with independent standard normal variables and transform them using the covariance or correlation matrix. The standard approach is Cholesky decomposition. Decompose the correlation matrix into L times L transpose. Then multiply L by the vector of independent normals. The resulting variables have the desired correlation structure. I would also check that the matrix is positive definite and validate the simulation by comparing sample correlations with the target values over many paths. Make sure to cover covariance matrices, Cholesky decomposition, independent standard normals, generating correlated shocks, positive definiteness, and checking simulated correlation against target correlation. Question 7. How would you test whether a time series is stationary, and why does it matter? Stationarity matters because many statistical models assume the mean, variance, and autocorrelation structure are stable over time. I would visually inspect the series, examine rolling statistics, and run tests such as the augmented Dickey-Fuller test. If the series is non-stationary, I might difference it, use returns instead of prices, or model co-integration. Without this step, a model can produce misleading relationships, weak forecasts, and unstable risk estimates. In your answer, talk about mean reversion, constant variance, autocorrelation structure, ADF testing, differencing, spurious regression, and implications for forecasting and risk models. Question 8. What is overfitting, and how would you prevent it in a quantitative model? Overfitting happens when a model learns noise in the sample instead of a repeatable relationship. I would prevent it by using proper train, validation, and test splits, cross-validation, regularization, and limiting unnecessary features. In finance, I would also require economic intuition because markets are noisy and regimes change. A model that looks excellent in sample but fails out of sample is dangerous, especially in a bank environment where decisions affect capital, pricing, or risk limits. Be sure to mention train-test separation, cross-validation, regularization, feature discipline, out-of-sample testing, model simplicity, economic intuition, and monitoring performance decay after deployment. Question 9. How would you explain a Monte Carlo simulation to a non-technical stakeholder? I would explain Monte Carlo as a way to test many possible futures instead of relying on one forecast. For example, if we price a complex derivative, we simulate thousands of possible market paths, calculate the payoff in each path, and average the discounted results. The output is not just one number. It gives a distribution of outcomes. That helps stakeholders understand expected value, downside risk, uncertainty, and sensitivity to key assumptions. Why answering? Focus on intuitive explanation, repeated random scenarios, distribution of outcomes, confidence intervals, business decisions, and avoiding unnecessary mathematical detail. Question 10. What is the difference between a martingale and a Markov process? A martingale is a process where the conditional expected future value equals the current value given current information. It captures a fair game property. A Markov process means the future depends only on the present state, not the full past history. A process can be Markov without being a martingale, and vice versa. In derivatives pricing, discounted asset prices are often martingales under the risk-neutral measure, while many short-rate and volatility models use Markov state variables. Make sure to define both concepts clearly, distinguish fair game expectation from memoryless state dependence, give a finance example, and avoid implying the terms are interchangeable. Question 11. How would you build and validate a credit risk model for probability of default? I would begin by defining default consistently, then build a dataset with borrower characteristics, financial ratios, payment behavior, collateral information, and macro variables. A common baseline is logistic regression, though machine learning can add value if explainability is managed. I would assess discrimination using AUC or KS, calibration by comparing predicted and realized default rates, and stability across segments. At JPMorgan, documentation, governance, and model risk review would be as important as statistical performance. In your answer, talk about default definition, feature selection, logistic regression or machine learning, calibration, discrimination, backtesting, data quality, macro variables, and model governance. Question 12. What happens to bond price when interest rates rise, and how do duration and convexity explain it? Bond prices generally fall when interest rates rise because existing fixed coupons become less attractive. Modified duration estimates the percentage price change for a small yield move, so a bond with duration 5 loses roughly 5% if yields rise 100 basis points. Convexity improves that estimate by capturing curvature in the price-yield relationship. Duration works well for small moves, but convexity becomes important for larger shocks and for portfolios with embedded options. Be sure to cover inverse price-yield relationship, modified duration, convexity adjustment, approximation accuracy, larger rate moves, and why risk teams use both measures. Question 13. How would you approach debugging a pricing model that gives unexpected results? I would debug systematically rather than guessing. First, I would verify market data, conventions, calendars, curves, vol surfaces, and trade terms. Then I would test simple cases with known analytical results or independent benchmarks. I would check boundary conditions, sensitivity signs, numerical tolerances, and recent code changes. If the issue affects production, I would communicate impact clearly, document the root cause, and propose controls so the same error does not recur. While answering, focus on isolating inputs, unit tests, benchmark trades, limiting cases, numerical stability, market data checks, code review, and communication with stakeholders. Question 14. Explain principal component analysis and how it can be used on interest rate curves. Principal component analysis reduces many correlated variables into fewer uncorrelated factors that explain most of the variance. For interest rate curves, PCA often finds that level, slope, and curvature movements explain a large share of historical changes. This helps compress curve risk, build scenarios, and understand portfolio exposure. I would be careful, though, because PCA is backward-looking. Stressed markets may produce moves that historical components do not fully capture. Make sure to mention dimensionality reduction, eigenvectors, variance explained, level slope curvature factors, curve risk compression, and limitations of relying only on historical patterns. Question 15. How do you evaluate whether a machine learning model is suitable for a financial risk application? I would not judge the model only by accuracy. For a financial risk application, I need strong out-of-sample performance, explainability, stable behavior across market regimes, and no data leakage. I would test sensitivity to key variables, performance by segment, and behavior under stress scenarios. The model also needs monitoring after deployment. If a simpler model gives nearly the same performance with better transparency, that may be the better choice in a regulated bank. In your answer, talk about predictive performance, explainability, stability, bias, data leakage, governance, stress behavior, monitoring, and whether complexity is justified by business value. Question 16. What is model risk, and how is it controlled in a large bank like JPMorgan Chase? Model risk is the risk of loss or bad decisions from flawed models, incorrect implementation, or inappropriate use. In a large bank, controls include independent validation, documentation of assumptions, testing against benchmarks, sensitivity analysis, code review, approval workflows, and periodic monitoring. The user also needs to understand limitations. A model built for normal markets may not be reliable in stressed markets. Strong governance reduces the chance that elegant math becomes a business problem. Be sure to cover incorrect assumptions, implementation errors, misuse, independent validation, documentation, ongoing monitoring, limitations, approvals, and regulatory expectations for model governance. Question 17. How would you calculate and interpret expected shortfall? Expected shortfall measures the average loss conditional on losses exceeding the VAR threshold. If 99% VAR is $10 million, expected shortfall asks, when losses are worse than $10 million, how bad are they on average? It is useful because it captures tail severity, not just a cutoff point. Unlike VAR, it is generally considered a coherent risk measure, which is why it plays an important role in modern market risk regulation. While answering, focus on tail loss beyond VAR, conditional expectation, confidence level, coherence, sensitivity to extreme losses, and why regulators prefer it for market risk. Question 18. Describe a project where you used Python or another programming language for quantitative analysis. I would frame the project around the business problem first, not the code. For example, I built a Python tool to analyze historical factor returns, clean missing data, estimate correlations, and generate portfolio risk summaries. I used pandas and NumPy for data handling, added unit checks for transformations, and validated results against a spreadsheet benchmark. The value was faster analysis with fewer manual errors. I would also mention version control and reproducible outputs. Make sure to structure your answer around problem, data, methods, code quality, validation, result, business impact, and what you would improve if repeating it. Question 19. If your model output conflicts with trader intuition, how would you handle the situation? I would treat the conflict as useful information, not as a contest. First, I would verify the inputs, assumptions, implementation, and market data. Then I would ask the trader what intuition or market convention the model may be missing. If the model is correct, I would explain the drivers clearly. If it is wrong or incomplete, I would fix it and document the issue. For material risk, I would escalate through the proper control process. In your answer, talk about humility, evidence-based review, assumptions, market data, edge cases, trader feedback, independent checks, documentation, and escalation if risk is material. Question 20. Why do you want to work as a quantitative analyst at JPMorgan Chase? I am interested in JPMorgan because the quant problems are both technically demanding and commercially important. The firm operates across major asset classes, has deep market data, and places real emphasis on risk discipline and model governance. That environment is ideal for someone who wants to build models that are mathematically sound, scalable, and actually used by decision makers. I also value the chance to work with traders, risk managers, technologists, and validators on high-impact problems. Be sure to connect your motivation to scale, market complexity, risk discipline, technology, collaboration, learning curve, and JPMorgan's position across trading, banking, and risk management. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.